Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday. And when you tune into my show, you're going to hear about topics that are important to the home business community. And today I want to focus on partnerships. So I'm seeing a lot of people get themselves into trouble with partnerships. So I want to talk about this a little bit so that you kind of get an idea of why this is not something that you just want to do all willy-nilly. So first, what is a partnership? A partnership is when two people decide to go into business, two or more people, okay? Two or more people can essentially, spit, shake, and decide to go into business, and voila, you have a partnership. If you have a multi-member LLC, it is also treated as a partnership. Okay, for tax purposes. So it might be an LLC, it might be a multi-member LLC, but it is taxed and treated like a partnership unless you actually make some other type of election. The problem that arises is that people want to treat partnerships as if it's like a sole proprietor, but with more than one person, or a single member LLC, but with more than one person. And that is not the case. And this is why I want to talk about the things that you need to track when it comes down to having a partnership. The first thing you need to track is basis. Each partner is responsible for tracking their own basis. Basis is the amount of cash or property that you contribute to the business. So if you're starting, let's say you've got a couple people starting a t-shirt business. If you've got one person that's contributing the t-shirts, well, that's property. What is the value of that property? If you've got someone, you guys decide that you want to just contribute cash, well, what is the amount of cash that each person is contributing? You definitely want to track your basis, and it's up to each individual partner to track their basis. It's not up to the partnership to track their basis. People get really upset when, we're asking as tax professionals, we're asking, what is the basis? Because this is why it's important. When your partnership starts making money and you start taking distributions, part of that is going to be a return of capital. So if you don't know what your initial contribution was, then you're going to wind up paying taxes on money that you shouldn't pay taxes on. Okay, because whatever the dollar amount that you contributed, you should get that back first, tax-free. Anything over that is then taxed, okay? But if you don't know what your basis is, your original contribution, then you're going to be paying taxes on money that you shouldn't be paying taxes on. And it's not the tax person's job to go figure it out. That's something for you, the partner, to know, okay? And then number 2 is the percentage of ownership. Now, the percentage of ownership and basis are two different things. The percentage of ownership is something that the partners decide together. Usually when two partners go into business together, they want to go 50-50. There are some times where there's 3 partners, 4 partners, whatever, but you have to decide on what your ownership percentage is going to be. It may not necessarily be equal. It could be a 75-25. It could be a 30-30-30-10, right? You have to know what that percentage of ownership is, because your profits and losses and all of those are distributed based on your ownership amount, okay? So you need to know going into a partnership what amount of this is gonna come to me, okay? So knowing your ownership percentage, and if that ownership percentage changes, okay? Because it might start out that you are all, if you've got 4 partners, you're all 25% each. But as time goes on, one partner may decide to step back, and then, that ownership percentage can shift, or another partner doesn't want to play in the sandbox anymore. What's going to happen to that ownership percentage, right? So the ownership percentages can change, and you definitely need to track that. Number 3, guaranteed payments. Now, guaranteed payments are what partners get for working in the business. You are not on payroll. You are not an employee. Can a partnership have employees? Yes, they can. It's just the partners are not employees. You get guaranteed payments, and that is an amount that you all agree on as partners to say, okay, Sue, we're going to pay you $1,000 per month for the work that you do. Joe, we're going to pay you $500 a month for the work that you do. That is what guaranteed payments are. Again, you do not, if you're working in the business, you do not put yourself on payroll. That's how you get paid. And you need to track what you get paid so you know how much you're paying taxes on, right? Okay. Then number 4 is profit and loss. Now, this is usually the part that most people get right. Okay. They track how much money they're making and they track how much money that they're spending. Okay, great. But again, going back to that ownership percentage, that all of that is going to pass through, whether it's a profit or loss, it's going to pass through to each partner on a K1 that is, based on your ownership percentage. So you need to know. So if you don't even know how much profit or loss you have, how do you even know if your K1 is right? And here's something else that I really want to make clear, because we got folks out here thinking that you can just go and produce a K1 just out of thin air. No, the partnership return has to be filed before you can produce a K1. It is not a standalone document that you just go and put some numbers in and voila, there you go. Okay. But knowing what your profit and losses are, then you can actually go back and review your own K1 to make sure it's right before it gets added to your personal return. And then number 5 is your balance sheet. Okay. You guys, the balance sheet is similar to a profit and loss in that you've got pluses and minuses, but it's really not the same thing. A balance sheet is talking about assets and liabilities. What assets does the business have, and what liabilities does the business have? Liabilities. Do you have a business credit card, or is there a balance? That would be a liability. An asset is if you've got accounts receivable, right? People owe you money. They need to pay you bills. That's considered an asset. Okay. So you have to know what the assets and liabilities are for your business, because in the event that you have to liquidate, meaning that you all decide you don't want to play in the sandbox anymore, you don't want to be in business anymore, you want to close it down, or if one partner decides, you know what, I'm done, I'm taking my toys and going home. When you've got to liquidate this partnership, then you need to know what assets and liabilities that you have, because that's going to have to be distributed to the partners in some kind of way, right? Those liabilities are going to have to be taken care of, right? Assets, they're got to go somewhere. So a partnership is so much more than just, let's spit, shake, and go into business. It's so much more. It's not just a sole proprietor with many people. No, this is not it. And I really want you guys to understand that, because when it comes down to the filing of the taxes, people are shocked to find out that there is actually an additional return that has to be filed. Even though the business itself does not pay taxes, the partnership does not pay federal taxes. You might have something on the state end. It depends on where you live. Don't ask me. You have to know your state laws pertaining to partnerships. But on the federal level, partnerships do not pay taxes. The profits and losses are passed through to the personal return, and taxes are paid on the personal return. Okay. But if your K1 is jacked up, then your tax return is going to be jacked up. But you do have to file that 1065 information return. And this is not, again, okay, because some of you really believe that just because you put numbers in a software that you have properly filed your partnership return, and that is simply not the case. If you don't know what you're doing, you should not be doing this. Partnership returns, even on a small level, can be complicated, but when you've got a lot of money involved and you got a lot of partners involved, it can get really, really ugly. Okay. Just letting you know. All right. So, so that's it when it comes down to these partnerships, you guys. Partnership returns are also due in March. The official thing is the 15th day of the third month after the end of your financial year. Most people are on calendar years, so that would be March 15th. But if you are that rare bird that is on a fiscal year, whew, that makes things so much more interesting is due the third month, the 15th day of the third month after your the close of your financial year. Okay. Whew. All right. So that's it for today's episode of Home Biz Tax Talk. If you have a partnership, if you are in business with someone, more than one person, you really, really need to consult with someone. Okay. So thank you guys so much for tuning in to Home Biz Tax Talk. Again, we air Monday through Friday, and you can come right here to get your questions answered about your home business taxes. All right. Have a great day, and I will see you all next time. Bye.